Hi, and welcome to the breakfast case. This is a video tutorial to help you understand how to complete this case. First thing you should do whenever you attempt one of these financial analysis cases is to review the instructions. So you're going to work as a financial analyst for Cereal Depot, and your boss wants you to conduct an analysis on the data provided. Please answer the following questions. Okay, so here is the data that we have to work with, and we're going to complete the worksheets. We're going to create a subtotal at the top of each worksheet, and we're going to find or calculate the average total days on hand and gross margin, I guess for the subtotal, and the notes down here describe how to calculate that. We need to highlight using conditional formatting items over 200 days, gross margins under 5%. We're going to develop a sales strategy for next year by copying over the worksheet. So we're going to create a new worksheet by copying over the worksheet. New year data. This is this worksheet, and it's actually New Year's data. Actually, I think it makes more sense. This is New Year data, current year. Keep them congruent. Okay. Name the worksheet price increase. So basically create a new worksheet. Call it price increase. Okay. Raise prices where needed on items, especially items below 5%. No item should have a gross margin less than 5%. Your goal is to maximize profits. No price can exceed $10. For every percent increase in sales, it will result in a 1% decrease in unit sales. So if you raise sales price by 10%, unit sales will decline by 10%. That's why it says negatively correlated. After you make your sales price adjustment, compare the current year data, days on hand, to price increase days on hand. Discontinue any items greater than 365 days. So I see a spelling error. I'm going to go here. All right. All right. So let's move on to the next. Please use pivot table feature in Excel to create a profit analysis based on brand name. Use the data you have put together so far to give me sales data, sales dollars, sales units, profits, weighted average GM by brand name. Sort the brand names in top sales, top units, and top profits. Okay. Write an executive summary, how your strategy will affect next year's sales, profits, and inventory levels. Here's a special note. Any discontinued items contribute a 35% write-off to cash flow. That's because of the tax deduction. So I'm going to go ahead and I'm going to change this to the current law is 21%. It's going to be as a write-off to cash. So if you discount an item, the total cost of that item can be multiplied by 21%. Let's keep this. And list it as an increase to cash flow. Okay, so we can list any of the discontinued items that we feel we should just throw away because there's no sense in even trying to sell them, and we can get an additional write-off on that. So we'll talk more about that later. And here are the notes. So basically we're liquidating this business, and we have 1 year to do it, and we can't order any additional inventory. Okay, so those are instructions. So let's go to current year data. So we have the item number. So first thing I'm going to do is I like to keep my titles tidy. So I always like to center them. See, doesn't that look better? And then I'm going to put on this, let's put a strong, thick box around that so we know. So we have our item number, and these are general. Our description. So this is the description of the cereal. This is the brand name or the company. that's running these or making these products. Sales price per unit, cost per unit, total sales, or say total sales dollars is simple. Take my sales price per unit, multiply it by my total units. Oops. Sales price per unit multiplied by my total units. So that would be my total sales. Now I want to, of course, form that in currency, and I don't need change. So let's bring that down. Cost of goods sold would be my cost per unit times my unit sales, and don't need change on this, but this is currency again. So bring that down. Gross margin percent. So to calculate this, what is this here? Okay. All right. So what we're going to do now is calculate the gross margin percent. There we go. I don't know why that plus is hanging out there. Let's see. Gross margin percent. All right, gross margin percent. Sorry about that. I was trying to get rid of that plus sign. All right, so what we're going to do is we're going to take sales dollars minus cost, which basically gives us our gross margin per dollar in dollars. Then we're going to divide this by our sales dollars. So it's not a dollar amount, it's a percent. So we're going to change that, open it up by, and we'll just flash fill that. So end of year inventory units. So this is the inventory we have in stock. So the inventory value is going to be our stock quantity times our cost would be the value of the inventory. So this is the cost of the units, so this is the amount of units we have left. So this is the inventory value. And then days on hand. So let's make it, okay, so calculating days on hand, if we go back to the memo, we see the note here, we're looking at how to calculate days on hand. Okay, so we have total inventory, right? So we can take a total inventory. So we're going to assume that's total inventory units, and we're going to divide by sales units divided by 365. So let's go back to the current year. So we're going to take, okay, so we're going to take the sales units. No, that wasn't right. Inventory units. So right here we have our end of year inventory unit, and we're going to divide that by our sales units, which are divided by 365 days, which gives us our sales per day, and this is our days on hand, and we're going to make this one number. Okay, so 384 days on hand. Does that make sense? So our inventory, yeah, because our inventory is greater than our sales units, so that means it's going to be greater than a year. So yep, that makes sense. So we'll just put that down here. Okay, now the second item here in the memo said to create a subtotal at the top of the worksheets to add the columns. So let's go back here. So we need to go insert, and the only thing we need to total, doesn't make sense to total the per unit items. So we need to total, and I'm going to use the, this up. I'm going to use this summation, quick summation tool to calculate sales units. All right. And then we also, I can just kind of drag this across. So this would be our total dollars. And then this is cost of goods sold, which is also in a total format. And so we're going to, and we can also add up, just copy this across, we can add up end of year stock and total inventory value. Okay, so gross margin percent. Here we're not going to do a total here. So what we're going to do first, let's clean this up. I'm just going to, let's put these into currency first. And then this is units is not a currency. And then we have, this is units as well. Okay, so let me resize the columns. Let's make these smaller so I can bring in, okay. And I'm going to use the accounting to signify that they're subtotals. And I can also here in description go, I can just say totals. All right. And let's clean this up. Just thick border around here. Okay, that looks better. Now, to calculate the gross margin percentage, it's the same formula as below. So I can just copy this up here. It's the same formula. I'm taking, what I'm basically doing is we're taking G, total sales dollars, minus H, cost of goods sold, divided by G. So this needs to be a percentage, just changing the format. So that's our average, weighted average gross margin. That's how you calculate that. Now we want the days on hand. So we're going to use, it's going to work the same formula as down here. So I can just kind of copy this formula up. And what we have here is 193 days. Because this formula also works on the total. So it's going to be a year in inventory divided by total sales units divided by 365. So that's how we calculate our days on hand. Okay, so we have our totals done. Let's move to next year's data. So here, cost per unit. So we don't have it here in this total, but we can use a VLOOKUP to bring this in. So I'll use a VLOOKUP here on my formula bar. And let me shorten this so you see I'm going to work with this. So what we want is the item number. The table array will be from the current data. And this would be the fifth column. 1, 2, 3, 4, 5. So the column index would be 5. And then false. And you can look up what that means down here with the syntax. All this information is here, including why false. Because we want an exact match, which equals false. So I'm going to hit done. And you see that okay, so let's just move this home. Okay, so here we have it's general, and over here we could have switched this number, but they're both general as long as they match. And if we look advantage, and if we search for 11011, so if we go over here, control find 110011, find next, we see advantage here, and it is 380 is the cost. So we just want to make sure that that works. So we have the cost per unit as a VLOOKUP, and we'll lightening that down. So next, so we have a cost increase. So next year's cost would be last year's cost multiplied by 1 plus the increase. So next year's cost per unit, and again, this is currency. So that makes sense. So lightening that down. Sales price per unit. So again, this is going to be a VLOOKUP, and this is going to come from the previous table. So again, we want to, this will be our lookup value, our table array. 1, 2, 3, 4. We just need sales price, so 4. And done. Okay, so we got, I must have messed something up here. Let me start over. So one thing I'm going to do, you can always do this too, because I think it works better when these are numbers. So I'm going to convert both sides to number. General, I always find that a little wonky with the V lookups, but it does work. So let's convert these to number on both sides. I like the center of these look better. Okay, so let's try that again. Formulas, function, VLOOKUP, lookup value, table array, these 4 columns, 4, and false. Oh, okay. All right. So this is what we want. And let's move this to a currency. Okay. I think that spill issue was coming up because it was formatted as percentage, and some of those numbers are rather large percentages. So, okay, so we're done with this. This how it worked. Okay, so we have our two now. Next year's price increase. This is what we have to decide. What's going to be the price increase for next year? So we could say, let's move everything up by 10%. So this will be our price increase, 10%. That's just a what if right now. And then we're going to take our sales price multiplied by 1 point, let me just put this column here so I can change it later. Okay, so that will move this up to, I just want to copy this format over. Okay, so that'll move the price up to 466. So I'm just proposing a 10%. That was something that strategies for this price increase we can look into later, but we have to remember that nothing should be higher than $10 here. So that we could put an if statement in to say, if it gets above 10, we should put some logic in here to make sure that these sales prices don't go above 10, because that was a parameter. So the adjusted sales forecast. So basically here we said that if price increases by 10%, sales forecast will decrease by the same amount. So what we're going to do is we're going to say this multiplied by 1 minus the price increase. And we see that the sales forecast went down by 10%. So this way, if I wanted to change this to 11, we see that both the sales forecast and the price increase change. So I did this, if I do 50%, we see that, let's see, 10, no, this should not change, that doesn't change. This is the current forecast, this does not change, adjusted. So if I were to see this as a, let's just format these columns so it's easier to read. Okay, 340,000. If I was to increase this to a 40% increase, you see this goes down 50%. So our sales get cut in half by 50%. Here, if we just do 10%, sales just go down 10%. So that's a consequence of raising prices, sales go down. But in some cases, it's better to sell less at a higher price than more at a lower price. Okay, we're going to move over now. Let me shrink these columns. Okay, so total cost in dollars. So let's see, let's read the rest of it. Total cost dollars, total sales dollars, next year's gross margin. Okay, so I'm going to relabel this total forecasted, total forecast cost, total sales, maybe that's, I'm just going to say total adjustment cost and total sales. And adjusted dollars. because I want to use these sales figures in my calculations, and I don't want to confuse it with the regular sales forecast. So it might actually confuse you if I do that. What if I say total forecasted cost? Yeah, I think forecasted works better. Forecasted adjusted. I know that's spelled wrong, so it's easy to fix that. Oh, it's going to go through the whole document. No, I don't want to do that, so I'll just fix it. No, that's actually spelled correctly. I'm sorry. And we want to do the same thing here. Total sales, and maybe I'll make it easier myself, and I'll just copy this here. So when I paste it in here, that, I mean, I'm going a little overboard, but I want you to make sure that you know I could also take this sequence here, and then I could put in a light color just so we know that they're grouped together. Okay. Now, how do we calculate adjusted cost? We take our adjusted sales and we multiply by cost per unit, using next year's cost per unit, because this is adjusted. And then we're going to take our sales forecast, adjusted sales forecast, and we're going to multiply by our next year's sale price. All right, so let's make these both dollar terms. Flash fill them down. Okay, so now calculate the gross margin. We're going to take sales dollars. Let me start with my parentheses. Sales dollars minus cost divided by sales dollars. Oops, didn't get that last part. Divided by sales dollars. Okay. So that would be my gross. Actually, this is the formula. Current year, we want this. This should be the formula for this one. Okay, so we want this, and yes, this is not what we want, because this is next year's gross margin but we want the current year's gross margin. So the current year we can get from the current year data, or can we calculate it from, we can calculate it from up here. So we could say we have our current year sales. Yes, we can do current year sales. I should start with parentheses, current year sales minus the current cost divided by the current sales price. Okay, so we're going from 10% to 16%. So that way, if we did increase this to 15%, we see our margin goes up here, and that's what we're trying to play with. So let's undo this, and let's flash fill this down. Okay, so we should also make we're asked to make totals. So let's go back here and insert. So none of these are total. This is the first amount that's totaled. I'll use my quick summation tool, my quick keys to calculate. And I'll just pull this over. And these are both in units, is fine, but these are in dollars. All right. Now, to calculate the gross margin, that's the average, that's the gross margin using this formula here on these cells. But current year, I can't do that for current year because what I would have to do, either I'd have to make columns for, let me move this over a bit. Yeah, so I don't think you saw it. What I basically did is I just took the formula from here and moved it up here, so that would work. But this would not work here because, whoops, because there are no formulas in these cells. So what I could do is I could create a formula and calculate, rather than creating extra columns, I'll just create a formula to calculate this. But actually, do I have it over here? I do. So if you see over here, this is where we calculated current year gross profit margin. So I could just say, bring that over from the current year tab. Because in the current year tab, remember that we calculated using all the current year data, the gross profit margin off the current year information. So I could just bring that over. And now I can highlight these with the underline, and I like to center these so we know these are totals. Okay, so we can see here that current year's profit margin and next year's profit margin, we are actually going down in gross profit margin. So how could that be? Well, it's because costs went up. So since the costs went up faster than our sales price, we're not really improving here. So maybe if I were to do a 15% increase, we see that our gross margin goes up, but our forecasted sales dollars goes down a little bit, and our forecasted costs will change as well. So let me undo that. So watch these two fields here when I change everything to 15. See how they change? So even though the margins went up, so really what we would want to also know is let's calculate total profits. So because margins are good, but maybe we want to create a column here that's going to say total gross profit dollars. So this is simply our sales dollars minus our cost. So we would want this column, and let me resize these columns. Move this over a bit. I'm going to resize these a little bit so we can see our number here, okay? And we want to make this congruent. All right, so this is our total gross profit. So when we were at 10%, you can play around with these percentages, we see that our total profits go down. If we were to do 20%, so the ramification of doing 20% is that our sales forecast is going to go down by 20% rather than 10%. So we're going to sell less units, but does that generate overall more profits for us? So we want this number to be as high as possible. So you're going to actually have to go in, because we have 200 lines of data here. So you can go in one by one to see, because we remember this can't be, nothing here can be above $10 a share, $10 per sale price. So you can actually kind of play around with this goes, so we get up to 40,000 in profits. If we do a 50% increase, it only goes up by 4 million. So this is what you can kind of play around with. I'm just going to leave this at 20. So this is what we're kind of comparing with our total gross profits for next year based on these increases. Now, you could use Solver. In addition, if you know how to use Solver, you could use Solver to also get the optimal gross profit dollars. And so Solver is another tool that can be used, and I believe it is on the, So there is this solver tool. If you have your developer, it works on different Excels work differently. You may want to look up on the internet how to install solver into Excel if you don't already have it. But for my particular Excel, which is a Mac-based 2016 Excel, I go to add-ins. I can click on solver add-in, and then over here it'll create a dialog box where I can pick an object to optimize, and then that object would be, I want to optimize this. To maximize, so maybe I want to, next year's sales price is what I want to optimize. And I could have my constraints, which is, we put in sales forecasts and sales price, can't be greater than $10 a share. So different constraints you can put in. Then you got different models to choose from, and different engines to use. And then what that is going to do is, this is not the full instructions in Solver, that could optimize. And basically what the Solver tool will do is it will set next year's sales price, or actually you might want to do a price, the price increase on next year. It'll set to the optimal price increase. If you use constraints like can't be greater than $10 and forecasted sales can't be lower than 0, you can put in these constraints and you can develop a gross profit that would be the absolute maximum gross profit you could get, and it's going to change every one of these cells individually as it runs through all these parameters to figure out which is the best. But the limitation is I think you can only do about 20 cells at a time, or maybe 50 cells at a time. So there's some limitations to Solver depending on which Excel you have and which Solver tool you're using. But if you know how to use Solver, which you may have learned from another class, you're welcome to try it. My expectation is that you may not exactly know how to do it 100%. So I don't really expect you to use Solver if you don't want to. Okay, so let's go back to the memo. So here we completed the subtotals. We didn't highlight any days on hand. So basically that over here, we can select this column and to do conditional formatting, home and conditional formatting, highlight cells greater than, and we could just say 200, and we can change it. Maybe we don't want red. Maybe we'll do a fill border. Okay, so then it just quickly highlights. So that's simple enough to do. Develop a sales strategy. So this is where you could use Solver, or you could just do a standard percentage, whatever you feel is necessary. And you have to make sure that these constraints about for every sales price that goes up 1%, sales units go down by 10%. And then over here, say, increase. Okay, so then it's going to say use a pivot table to create and slice up the data to find by brand, these characteristics by brand. You should know how to do that pretty well, and then write up the executive summary. So this note here on discontinued items, let me just see something here. Okay, so this is a constraint, can't be greater than $10 a box, your sales price. And you have to also remember that you can't increase sales 100% because that will totally reduce your sales to 0. So there's 2 constraints if you're going to use Solver, which you don't have to. So if we're going to liquidate, so basically what this is saying is you could actually go to next year's data here, and if there's any items here where the gross margin is negative, like these are negative here, so you could say, well, let's just make this, and if you increase this 100%, you can't do that, increase it by 90%. Now gross margins do go up, but you're selling very little boxes. So maybe this is something that doesn't make sense. If it's not going to contribute that much profit-wise because we're selling so few boxes, we may want to just discontinue it. So if we were to discontinue it, I would suggest, say you find a line that you want to discontinue, the write-off we would get is you could create a section somewhere, a new tab maybe that's called discontinued, and you can remove the inventory from this line. And so where is inventory amount? Oh, that's something that we have to check too, because we have this on this column. We have our end of year inventory. Should probably bring that over here, because we have a constraint that we can't sell more than what our ending year inventory is, even if our forecast is higher. So it might be a good idea to add a column and bring the inventory values over to make sure you're not selling more than what our remaining inventory is, because that's another constraint. But our inventory value, if we're going to do a write-off, we would say that for this particular item that has a negative gross margin, we don't want to, better off not selling it if we're losing money than selling it. So then we could take the inventory. So you can kind of, might make sense to bring the inventory over. Call it I don't want this to be too big, so it's called beginning inventory. So last year's ending inventory becomes this year's beginning inventory. And so let's go over here. I'm going to take this format, bring it over here, and then we're going to do a VLOOKUP. This item, table array. I'm going to go all the way to, I fell off the start over. Table array. I go to that's all the way out here we want. Let me see, I gotta see what column is it that we're trying to first. Let me just format these columns again. Let me close this. Okay, this is end of year inventory stock is what we want, column J. Let me just squeeze these down a little bit. All right, let's try this again. Formula, VLOOKUP. This is our lookup variable, table array, current year. We want it out to column J, and then 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, so we bring in our inventory, and now we can calculate the write-off. So this is, say this is a negative, just put it over here. This for discontinued, so say we're going to discontinue this field, we would say, we would simply take the beginning inventory multiplied by the, when we use last year, we can use we'll use this year's cost, next year's cost. And then we're going to multiply that by 21% because that's a write-off percentage. So this would be, so we go discontinued cash flow. So we can say discontinued cash flow, and you could even put an if statement, say if, why aren't these wrapped? I want to merge the cells, I want to wrap the cells. That's better. So we could even put an if statement, and we could do it sort of like this. Copy this. So we could do an if statement that would be formulas. If statement here, I'm going to say if this is less than 0, if true, then we can put the formula in. Let's see, did I tried to copy it and that didn't work. So we could put the formula in, which would basically be I'm going to actually C3 times F3 times 0.21, otherwise 0. Okay, so I could take this if statement here. I can copy it down, and we see that only when it's negative will, and we want to format this currency. And you can see that the flash fill doesn't work if there's no data on either side of the column. So I can't flash fill this. Well, sometimes what I do in that case is I go to the bottom and I'll put like just a 0 there, so I can do a copy and click key down. Okay, so anything that's negative now is being discontinued cash flow. And then I can just create a total for the discontinued cash flow. And this could be added to, we can call it total cash flow. And here we'll take our gross profits and we'll add back in our discounted cash flow, our discontinued cash flow. So what we're basically saying is but we have to also remember to take out the sales value in here because we don't want to double count it. But this is basically the sort of the idea of what we're trying to do, is figure out if we're going to discontinue it, how much cash flow will we pick up as a tax write-off, and we should add that to profits. But I just want to remind you that if you are discontinuing, then you can't count the sales or the profit in the overall margin. So you would have to somehow deduct them from your total sales and profits, which would basically be one way. Basically what I'm trying to say here is, if one thing you could do, I'm going to copy this, paste special, just cancel, what is this? Control copy. I want to paste special, and I want just values and number formatting. So now I've removed that if statement, and if I can actually sort. I'll sort on column R, and I want smallest to largest. Okay, so now anything that's discontinued is down here. And what I should basically do is erase these sales. So I'm just going to erase this data here. So it's not in my total. So now we'll see that the profits actually go up because those were going to be losing money. So that would be an accurate way of the items that are discontinued. We don't want to show the sales and profits for those. Okay, because they're all, what they're doing is they are going to be losing money because our costs, if you look at these two columns, our costs are going to be greater than our sales. Okay. All right, I'm certainly going off on a tangent here, but that's sort of kind of just to explain. You feel free to do that better. That was just the concept. And I executed in a really poor way over here, but I just want to show you the concept of that so you understand what we're trying to do with those numbers. Okay, so that you still have to write the executive summary and do the pivot tables. On this case, that I'm not going to walk you through, but I just want to walk you through basically how this case should have been laid out. I hope you found this video useful. Take care.